Good morning to all of you. My name is Kushru Pantaki, and I'm a partner with Walker Chindiok and Company, LLP. It's indeed a pleasure to address you through this particular webinar on normally what we see as common errors that appear in the financial statements, which actually get sort of detected based upon some of the reviews being carried out by FRRB, etc. Friends at the outset, I hope all of you are doing well and you are safe and healthy, and I'm sure that your dear ones are also doing well. At the outset, let me thank the Accounting Standards Board and the FRRB for giving me this particular opportunity to address you this morning. And I'm very sure that you will enjoy this particular session, given the fact that it talks about some of the contemporary issues and what we have actually sort of observed over a period of time in terms of some of these commonly appearing errors in the financial statements. But before I actually start the presentation on this particular subject, I would just like to make a couple of announcements. We are talking about accounting standards, which are pure accounting standards and not Ind AS per se. These are general accounting standards, what we follow and what we call as Indian GAAP. So,
sir, your audio is low.
What we call is, am I okay now? Am I audible?
No, sir.
Am I audible now?
Can you remove your hands-free?
Okay.
Yeah, it's fine, sir.
Thank you. Yeah. So these are the accounting standards, what we call as accounting standards, and not Ind AS. And this is something which I would like to mention at the beginning itself, that we are talking about accounting standards and not Ind AS. I would also appreciate if at all your questions that come up on the chat should also be confined to only these 4 accounting standards, which I'm going to talk about today. And I will not be able to answer anything beyond these 4 accounting standards for paucity of time. So this is my request to all of you, that please post only your questions relating to these accounting standards, which are basically accounting standard 3 on cash flow statements, accounting standard 5 on net profit, prior period items, etc., accounting standard 7 on construction contracts, and accounting standard 9 on revenue recognition. I repeat again, this is not Ind AS. These are accounting standards generally accepted in India per se. So we are into this particular audit finalization season currently. Listed companies have already adopted Ind AS, which are basically converged towards IFRS. But yes, there are many other companies which are non-listed entities, which are companies where Ind AS is not applicable. And even today, a good amount of corporate in India actually follows the earlier accounting standards, or what we call Indian GAAP per se. And that particular season is now going to pick up significantly because we are coming out of the conclusion of the busy season for listed companies. And we will now be sort of, working on many of these unlisted companies, which continue reporting under Indian GAAP per se. So for the purposes of this particular presentation, I will call these non-Ind AS accounting standards as Indian GAAP for your understanding per se. What we have observed also is people get mixed up between the 2 accounting standards. Definitely Ind AS are much more practical. There is a lot of flexibility given. Estimates and judgments definitely have a much wider scope under Ind AS. But I think even under the Indian GAAP or the Indian standards, there is a lot of scope where you can apply your judgments, apply your estimates. They only need to be consistent over a period of time. And there should be a proper rule being followed in terms of recognition and measurement principles, and at the same time, in terms of presentation and disclosure requirements. So let me give you a little perspective on some of these accounting standards, post which I will deep dive into the presentation, which will talk about some of the commonly observed errors in the financial statements. Coming to this accounting standard 3 in relation to cash flow statements. I just wanted to share with you about maybe 5 or 7 minutes overview that the cash flows basically are a very, very vital information insofar as the financial statements are concerned. There are many enterprises where the cash flow statements are not applicable, and there are quite a few enterprises where the cash flow statements are applicable. In fact, if you look at this entire body of cash flows, it gives you a complete perspective about what is the position of cash flow for an organization and what are these different kinds of cash flows. They are broadly classified as cash flows from operating activities, from investing activities, and from the financial activities. So basically, this is the broad framework of a cash flow that a company or an enterprise will prepare. Then, of course, there is an applicability in terms of whom this particular cash flow is applicable. So there are enterprises, as I mentioned, to which this is applicable, to enterprises with a top line of a certain amount, to enterprises where there are loans being availed of an amount which is higher than the thresholds. Then, of course, it is applicable to a banking company or an insurance company. And of course, there are many, many other companies to whom it is applicable. Definitely, when it comes to a listed company, cash flows are very much applicable as well. It also actually enables the readers of the financial statements to understand how the position of cash is going to be over a period of time. And what is the position of the cash flow as at the end of the year, because this is a financial statement. And normally you would prepare this along with your other financial statements as part of your annual reporting exercise. Within the cash flows as well, you are required to distinguish. Like, for example, in the case of a financial statement, whenever there is a major impact in terms of any extraordinary item or any exceptional item, then even in the case of a cash flow, if at all there is any kind of a cash flow which is basically arising not from an ordinary activity, but from an extraordinary activity, then you need to separately disclose the impact of that particular cash flow arising out of that extraordinary item, which is also very, very important. And that again requires a separate disclosure per se. During the year, the company may acquire or dispose of a unit, or it may acquire a joint venture, a subsidiary, an associate, or whatever. And therefore, these are major transactions. The objective of a separate disclosure of these items is to ensure that in the event that there is a significant impact coming on the cash flow arising out of these financing activities or investment activities, then you need to make a separate disclosure for the readers of the financial statements to understand as to what these cash flows are and what could be the potential impact of that on the enterprise's cash flow, so that the impact of the normal activities can be definitely differentiated from the impact of the other activities as such. Then within the cash flows also, you have certain things like, for example, you have got interest, which you normally would pay on the loans that you have availed, or you may have interest being received from a particular loan that you have placed or you have given somebody. And therefore, these are to be recorded in a particular manner. For example, the cash flows from the interest paid and interest received by a financial institution is recorded differently from a company which is not into the financial services business. Just to give you an example, let's say that in the case of a bank or in the case of an NBFC, they are in the business of lending and financing. And for them, this is basically their core activity, their day-to-day activity, the normal operations. And therefore, cash flows arising out of that are normally being shown as an operating activity. In the event that it is not a financial services company or not a financial institution, these are recorded differently, either as an investing activity or as a financing activity, depending upon whether it is interest paid or interest received as such. Of course, in addition to that, you have your interests and dividends being received as an ordinary enterprise. So, for example, when you receive interest or when you actually receive your dividend and you are into the normal business of manufacturing, these are basically the incomes being received out of some financing activity that you have carried out. And therefore, these are being recorded as cash flows from financing activities. At the end, of course, generally what we normally do is the cash flows are computed from operating activities, from investment activities, and from the financing activities. And then you have your net number as to whether it's a cash flow which is in the nature of generated or it is a cash flow which is being used. So it is a net number. Either you are positive in terms of positive net cash flow, or you could be negative in terms of net cash outflow. What is the impact of that on your cash balance, or the what we call as a cash and bank balance at the end of the year? The impact of that is that you have a cash and bank balance at the beginning of the year. Let's say hypothetically it is 100 rupees. Then you have your net cash inflow of another 200 rupees, which is added to your opening balance of cash and bank. And therefore, the total amount of cash and bank balance at the end of the year would be 300 rupees. So this is how your cash and bank balance at the end of the year is equal to 300 rupees as against 100 rupees at the beginning of the year. And of course, the impact of the transactions which are operating, investing, and financing in nature during the year has resulted into a net cash inflow of 200 rupees, which adds to the opening balance to bring a closing balance of 300. What is important over here is some of the cash balances are not freely available for use, which you have at the end of the year. There could be some liens, there could be some restrictions, there could be some covenants, etc. And therefore, your cash and bank balances at the end of the year or at the beginning of the year, if at all they include such balances, then they need to be separately disclosed, or an appropriate disclosure is required to be made so that the users of the financial statements are in a position to understand that what is restricted and what is not restricted. What is restricted comes out as an appropriate disclosure, and the readers will ensure that these are not freely available either for distribution or for any other activities. Coming to the last point on the cash flow stand, as I said, these are my presentation is more on commonly observed errors in the financial statements. It is not on the accounting standards, but I thought before we deep dive into the accounting standards, we will actually sort of talk a little bit before I deep dive into the commonly observed errors. We will talk a little bit about what this particular standard is about. Generally, you will see two different kinds of cash flow statements. One is called the direct method cash flow statement, and the other is called the indirect method of cash flow statement. In the case of a direct method of cash flow statement, as it says direct, which means that the presentation is straightforward and simple in terms of operation acts, financing and investing activities, and where you actually come out with separate cash flows from each of these activities. In the case of an indirect method, as the word says indirect, you need to start with your net profit before taxes, as is there from the P&L account. To this, you add back your non-cash charges and your non-cash incomes, which could be the nature of interest, which could be the nature of dividends, which could be again certain amounts which are basically unrealized unrealized losses. Then there are certain expenses which are provided for. There are certain incomes which are accrued, may not be paid, may not be received. So you make all those adjustments, and then you come to the actual net cash inflow or net cash outflow from your operating activities. And the remaining part of your cash flow statement, which is basically the cash flow from investing activities and cash flow from financing activities, are exactly presented in the manner in which it's being presented under the direct method as well. So these are the two methods. Normally, generally, you would see in the case of financial services companies, insurance companies, etc., they prefer to have a direct method being presented for the purposes of disclosure. Whereas in the normal cases, you see the indirect method being presented. Whichever method you use, you need to make sure that there is a proper disclosure that this is this particular method that you are using for the purposes of the cash flow statement. So this is basically an overview in terms of what is there in the cash flow standard. We will now deep dive into the specifics of the accounting standard as far as the commonly observed errors are concerned. I'll just upload the presentation for your purposes now. Devang, are you able to see the presentation here?
Yes, sir. Yes, sir.
So if you look at this particular slide, why does it say non-compliance? Because these commonly observed errors actually result into the non-compliance insofar as the recognition and measurement, insofar as the presentation and disclosure requirements of the standards are concerned. So I just wanted to give you a perspective at a glance as to what kind of deficiencies have been observed under the recent FRRB review being carried out last year, where it results into some of these errors related to the cash flow statements. Almost, if you look at this particular chart, and I will be able to share with you, almost 11% of the errors relate to some of the disclosures. Almost 17% of the errors relate to the manner in which the interest and dividends are being disclosed. If you look at it, around 18% again is in relation to errors between investing activities and financing activities, which means that something could be investing in nature and it's being shown as financing, and something which could be financing in nature is being shown as investing. And therefore, these kind of difficulties are coming up. A good amount of 16% is also in relation to some of the misappropriation of the definitions forming part of the cash flow statements, which is not coming out well in your financial statements. See, cash flow statement is a very, very important and an integral part of the financial statements. The standard is very clear of the format in which it needs to be presented and of the disclosure requirements as well. And if at all you would not follow, then these become errors in your financial statements, and therefore these particular errors actually get reported when FRRB or any other regulatory authority does this review. And of course, around 38% of the errors are basically others, which means general in nature as such. Coming to this particular, one second, please. I just have to put this window off. Yeah. Coming to this particular slide, I will just read out for the benefit, because we are going to spend time on the errors which have been noted in the financial statement. So I'll just read out what was the problem actually. From the cash flow statement which was given in the annual report of the bank, it was observed that the word net, increase or decrease in your investments, has been disclosed under the cash flow from operating activities. Further, it has been noted from the note on investments that such investments also include held to maturity investments. Now, as I mentioned at the beginning itself, that the cash flow is divided into three categories: operating activities, investing activities, and financing activities. If at all we are talking about any increase or a decrease in an investment, it is basically nothing but your investment activity. It is not operating in nature. You may recall that I had also mentioned that if the company or the organization is a financial services entity or a bank or an NBFC, which is dealing into money by giving loans and advances to others, by doing borrowings, etc., then for that particular organization, this can appropriately be called as a activity from operations. But if it is a manufacturing company or a trading company or a non-NBFC or a non-financial services company, which is not into the nature of lending, this is not an operating activity. So this is so simple to understand, but yet people make these kind of mistakes. And therefore, this particular entire objective of having this particular session is to give you a heads up as to where such errors have been noticed and how these errors can be minimized or eliminated if at all there is a proper understanding. So if you look at the observation now, which is basically the conclusion, it says only the cash flows that arise from the purchase and sale of investments need to be classified as cash flows from which are in the nature of available for sale or held for trading, need to be classified as cash flow from operating activities. So if it is a financial services company, for them, dealing in loans and advances or dealing in current investments is like a normal business, and therefore they can call it as a cash flow from operating activity. Otherwise, normally these investments, which are basically held to maturity investments, are generally being considered as investments, and therefore any transactions that relate to purchase and sale of such investments need to be classified as an investment activity. Look at the nature of this particular error. It's so simple, yet there are mistakes being made. Coming to the next question. From the note on non-current investments and its footnote, it's a non-current investment. It has been noted that during the year, all the equity shares in the 3 enterprises were purchased. So you have made investments in 3 enterprises, thus making them as wholly owned subsidiaries. So the company actually made investments in 3 subsidiaries as such. It was further noted that the cash flow from statement, that the difference between the opening and the closing balance of investments in subsidiaries have been shown as purchase of investments in the cash flow statements, and there was no indication of any sale of investment per se. I think the limited point that is being driven out over here is that whenever there is an activity which is important in nature, where it is important to highlight and emphasize the fact that this is not an ordinary activity, this is an extraordinary activity, where the company has actually made investments into 3 subsidiaries. It may or may not be material in terms of the total amount, but this is an important activity. And therefore, the users of the financial statements should be able to clearly understand, assess, appreciate, and see as to how it is being disclosed in the financial statements. And if at all you're going to make that particular disclosure in the cash flow, then that particular disclosure in the cash flow also needs to be made separately as an important item, as a separate item. Therefore, if you look at the observation or the conclusion, it says that it was viewed that since such cash flows result into acquisition of an enterprise, it should have been presented separately, clearly indicating the nature of the cash flow, rather than using the generic head of purchase of investments. It is not just a purchase of a normal investment, it is a purchase, it's an acquisition of business. These are subsidiaries coming into existence, and therefore you need to make that particular disclosure separately for the better understanding of financial statements. Let's go to the next case now. These are very simple errors, but I mean, this is a very, very basic presentation I'm making. It's nothing rocket science. It's just that, in the endeavor to sort of, quickly wrap up the audit or quickly wrap up the financial reporting, these mistakes go unnoticed. And therefore, it's important for us to understand what kind of these mistakes are. You look at the question again, or rather the case. In the note on administrative and other expenses, there is a particular item on exchange fluctuation amounting to a particular amount. However, the same has not been adjusted to determine the cash flow from operating activities in the cash flow statement. Now, this is basically an exchange fluctuation. Now, exchange fluctuation can be of 2 types. It can be a realized exchange fluctuation, where the loss or the profit arising out of the conversion adjustments during the year would have been made. And definitely you need to state or restate at the year end, which results into unrealized foreign exchange losses or gains. And therefore, the correct way of disclosure would have been that the entire amount cannot be considered to comprise only of realized foreign exchange, so as to have the adjustment being done. And therefore, the unrealized foreign exchange part of it should have been adjusted to determine the cash flow, which is the actual cash flow from the operating activities as per the requirement of AS3. Let's go to the next one. The annual report of a company, then it was observed that the cash and bank balance included balances in foreign currencies. You normally have, if at all the company has been dealing in foreign currency, your cash and bank balance will have exchange, which is not your reporting currency, but it can be your foreign exchange as well. However, there was no adjustment or reconciliation being shown in your cash and cash equivalent for the exchange rate difference. As we know, at the year end, you need to reinstate your foreign currency balances at the year end rate. This was not being done as a part of the requirement of the disclosures in the cash flow. And therefore, the conclusion has been that the effects of any changes in the exchange rates, which have not been reported as a part of the reconciliation of your changes in the cash and cash equivalents, need to be done while you report your cash flows in the cash flow statement. Look at the next one. In the cash flow statement of a non-financial enterprise, it is a non-financial enterprise, which means that the company is not dealing into financial services activities, it is not lending or it is not borrowing, etc. Under the heading of financing activities, an item of interest has been reported. Item of interest has been reported. Now, it was viewed that the cash flows from the interest income has arisen on account of the investing activity that you have made. When do you earn interest? When you actually make an investment, you earn interest. Okay. And therefore, this basically is nothing else but an investing activity. And it is therefore not appropriate that the cash flows from interest income has arisen due to the investing activity, while the cash flows from interest expense has arisen due to a financing activity. If there is an interest expense, you have actually availed a particular loan. It is a financial transaction, and therefore it is being called as a financing activity. Interest income is an investing activity. So one activity is investing activity, other activity is a financing activity, and you actually cannot sort of net it off. And therefore they should not be netted off against each other. This is a very, very commonly observed error in the cash flow disclosures, in the cash flow statements. And therefore, please be mindful of this particular important requirement. The next one again is talking about some of the companies, although are disclosing dividend paid under the cash flow from financing activities, they have disclosed the tax paid on dividend under the head cash flow from operating activities. Now, what is tax on dividend? It's basically your dividend distribution tax. This particular dividend distribution tax needs to be given the same treatment like the dividend, how you disclose it in your cash flow statement. And therefore, the correct way of doing it is the tax on dividend paid, which is your corporate dividend tax, should be shown along with the dividend paid in the cash flow statement as your cash flow from your financing activity. Of course, you can make a separate disclosure, but you need to show it as an item of cash flow arising out of financing activity. It is not an operating activity. The fact that you have paid dividend is on account of the fact that it is basically an expenditure on financing. And therefore, the tax related to that is also an expenditure on financing. They both need to be given the same treatment. And therefore, please do not classify it as an operation activity or an investing activity. It is a financing activity. And therefore, you need to disclose it accordingly. The next one, I think I covered it also in my initial overview of this standard. But this is, again, a very, very important point which people forget and they do not make an appropriate disclosure. The components of cash and cash equivalents, as have been reported in the balance sheet, includes cash in hand, cash at bank. There are certain earmarked balances against LCs, etc. Unpaid dividend account, because your cash and bank balances also will have your unpaid dividend accounts, which you will utilize to pay off the dividends when people actually claim it. It includes your interest accrued on fixed deposits. And the total of all these components matches with the closing cash and cash equivalents as reported in the cash flow statement. Now, if you look at it over here, you will automatically get an idea exactly what is the nature of this error. The balance of cash and cash equivalents, which are reported in the cash flow statement, is the same as in the balance sheet. It was noted that the components of cash and cash equivalents, it includes unpaid dividend over here, accrued interest over here, and earmarked balances against LCs, gratuity and superannuation amounts, which are not readily available with the enterprise for its use. And therefore, they should not be disclosed as a part of your cash and cash equivalents at the end of the year. This is the point that I am driving, that whatever is not easily available for use, whatever cannot be used for the purposes of business, whatever is a part of a lien, whatever is earmarked for a particular purpose, need not be disclosed as a part of your cash and cash equivalents at the end of the year. Or you need to make an appropriate disclosure to make sure that this comes out very openly in the financial statements. The next particular, there are quite a few errors which the institute, during the course of its review through FRRB, have noticed on this particular accounting standard. And this is again a very typical one. The next one that is coming up again is a very typical one. In one of the non-financial enterprise, again, a normal enterprise, manufacturing or a trading, the decrease or the increase in the long-term loans and advances has been adjusted as a working capital change under the cash flow from operating activity. When there is a working capital change, it is correct to say that it's a cash flow from operating activity. But these are your decrease or an increase in your long-term loans and advances. And your long-term loans and advances are not basically items which are operating in nature. Also, the cash flows arising from the same have been shown on a net basis in the cash flow statement. When do you show it on the basis of net? Generally, as per the standard, when you are in the business of financing or you are in the business of lending, then the net can be shown as far as the customers to whom the advances have been given, and if at all they have been recovered, you can show the net impact of that. But again, over here, if you look at the statement, it says it is not a financial enterprise. It is a non-financial enterprise. And therefore, the right way of doing it is that the long-term loans and advances basically are in the nature of an investing activity, and it cannot be a part of your revenue-generating activities. And therefore, it is incorrect to show this under your cash flow from operating activities. It is also noted that such cash flows should not be shown on net basis unless these are arising out of the enterprises which are in the nature of lending or which are basically financial services organizations. And therefore, for such organizations which are non-financial organizations, gross basis should be adopted for the purposes of disclosure. So in case if at all there is a lending, then you need to show it as an investing activity. Cash flow in terms of lending should be shown as an investing activity. And in case if at all there is a recovery of that particular amount, then again it has to be shown at gross as to recovery of loans and advances. So remember one thing, for a non-financial enterprise, increase or decrease in the long-term loans need to be separately disclosed under investing activity and should not be netted off and shown either as an investing activity or as an operating activity per se. This is a very, very important consideration, and many financial statements have actually disclosed it either on a net basis or shown it as a part of your operating activities, which is not correct. These are commonly errors, as I mentioned, and some of these errors are actually even coming out of the casting not being done properly or slipshod way of working. And therefore, if you look at the query over here or the observation over here, it says that the cash and cash equivalent as reported in the notes and the cash flow statement does not tally and the reconciliation was not given. Now, generally, when you have your cash flow statement, under your cash flow statement, you have your certain notes as to whether you are adopting the direct method or indirect method. Then what are these cash and bank balances at the beginning of the year, at the closing of the year? In case if at all there is any lien on that, then you will make that appropriate disclosure. And of course, you will have to reconcile in a manner whereby you are in a position to arrive at the numbers which are being presented in your cash and bank balances, forming part of the cash and bank schedule in the financial statements. So these days, of course, you do not have the schedules, you have got the notes. And one of the notes would be, it will be cash and bank balances. And let's say at the end of the year, it is 100 rupees. In your cash flow statement, if the number is different on account of the way the cash flows are presented, then you need to reconcile in a manner under the notes of the cash flow, whereby you are in a position to come back to the figure of 100, so that the readers of the financial statements are aware that yes, the cash flows, cash and bank equivalent under the notes to accounts ultimately ties up with your cash and bank balances, forming part of your notes to accounts. This is to give that particular comfort to the readers of the financial statements that there is a reconciliation and the numbers are tying up with the financial statements. If these reconciliations are not performed or they are not properly performed, or if there are errors, then these become very obvious in the financial statements and therefore they get picked up during the course of the review. from the cash flow statement of a financing company. Now, this is a financing company, so it could be an NBFC, it could be a bank, etc. It has been noted that the changes in the borrowings, including the debts that you raised for a tier 2 capital, were disclosed under cash flow from operating activities. Now, mind you, this is basically a activity of a NBFC or a bank which is in the business of lending. Now, once you're in the business of lending, you will also have your borrowings as such. So what was the way? This was basically an observation that it was being shown as a cash flow from operating activities. Now, borrowing, etc., of course, can be your operating activity, but it is relating to your tier 2 capital. And therefore, what is the right way of doing it? So cash flow on account of borrowings in case of all enterprises, whether financial or non-financial, should be presented as cash flow from financing activities. As a definition of financing activities under AS does not make any distinction between a financial and a non-financial enterprises. And therefore, to show it as an operating activity is not correct. So over here, you were actually looking at the changes in the borrowings. When you borrow, including any particular debt that you raise, it is nothing but a financing activity. And the standard does not make a difference as far as the borrowings are concerned. Now, whether it is a financial services company or a non-financial services company. And therefore, the borrowings for all enterprises, whether financial or non-financial, should be classified as a financing activity and not as an operating activity per se. The next one again is a very, very simple observation, but it gets missed out when people actually sort of, during the course of the audit, for whatever reasons. Look at the annual report. It says that the fixed assets which are lost due to a robbery were disclosed under the head cash flow from investing activities. I mean, when there is a robbery and an asset is particularly lost, what do? We actually recognize that particular loss. If it is a significant amount, we show it separately. If it is not a significant amount, it becomes a part of your disclosures, or it gets classified somewhere in the financial statements. Now, this is basically a loss which may not necessarily be a cash loss. Okay. However, this is a loss which may happen in your ordinary course of business. And it does not necessarily mean that you need to classify it as an investing activity. And therefore, the right way of doing it is that it is a non-cash transaction, which is what I had mentioned earlier, that any particular asset which is being lost on account of a theft or a robbery is a non-cash transaction. And therefore, it should have been excluded from the cash flow statement, first of all. So if at all you would go on the basis of an indirect cash flow basis, you start with your net profit as per P&L account, which is basically before taxes. And if at all you have booked that particular loss to the debit of your P&L account, you would add it back under that particular working of the cash flow from operating activities, because this is a non-cash loss. And therefore, your profit number needs to be reinstated to bring a higher number, because your cash profit would have been otherwise higher. It was because that you booked that particular loss to your P&L account, your profit would have been lower. And therefore, to bring it back to see what is the cash flow arising from an operating activity, you need to add it back. Similarly, over here, if at all you would have gone on the basis of your direct cash flow disclosures, this is not a loss arising in cash and definitely not arising out of an investing activity. And therefore, you need to show it as a part of your operations activity per se. Another important error, which we normally see in the notes to accounts in the annual report. What is basically the observation? The observation is, the error is that the provision for doubtful debt. This is basically a note coming in your annual report in the notes to accounts. The provision for doubtful debts, advances written off, an unrealized foreign exchange gain has been reported in the statement of P&L, which is fine. Certain amount of miscellaneous expenditure has been written off during the year, which includes preliminary expenses and deferred revenue expenditure. First of all, that particular era is gone when you will have something like a miscellaneous expenditure. If you remember, maybe a few years ago, 10 years ago, etc., we used to have miscellaneous expenditure sitting on the asset side as one of the last items. And then we used to have adjustments out there, etc., preliminary expenses and all, but that's not there anymore. You are not required to have those kind of disclosures. And there is nothing like a deferred revenue expenditure anymore, whether it's under Indian GAAP or whether it's under India's. However, I think as far as the right way of doing it is concerned, if you look at the comments or the observation, it says very clearly that although the non-cash items, such as your provision for doubtful debts, your advances written off, your unrealized foreign exchange gain, and etc., whatever, they have not been adjusted against the net profit before tax in the cash flow statement while deriving the cash flow from operating activities. So when you have your provision for doubtful debts, when you have your advances written off, and you have your unrealized foreign exchange gain, and if at all you are following the indirect method of cash flow presentation, you start with that particular figure called net profit before tax and extraordinary items. To this particular net profit, you are required to add back all the non-cash transactions, which are basically expense or income in nature. And therefore, provision for doubtful debts, advances written off, which are basically non-cash transactions, need to be added back to derive the cash flow from your operating activities. If this is not being done, then your cash flow will definitely be incorrect. I would say completely incorrect. And therefore, please take into consideration these things. From the cash flow statement of a financial enterprise, again in the business of lending, etc., it was observed that the following items were disclosed as cash flow from financing activities: the repayment of loan and the disbursement of loan. Now, remember in the second example, I had mentioned that if at all you are in the business of financial services, and if at all you are doing lending, then your loan repayment and your loan disbursed. So if at all you have disbursed a loan or if the loan has been repaid, it is basically a part of your operating activity. You are in the business of lending. It is a part and parcel of your daily operations. And therefore, they need to be disclosed as a cash flow from your operating activities and not the cash flow from your financing activities. But if at all there is anything on the borrowing side, irrespective of whether you are a financial service enterprise or a non-financial service enterprise, the borrowings and the increase or decrease in borrowings need to be shown as a part of your financing activity and not as part of your normal operations. So that is basically the kind of disclosures and the kind of classifications you are required to have as far as your loan repayment and the loan disbursements are concerned for a financial services enterprise. Going to the next question again. From the cash flow statement given in the annual report of a company, it was noted that the exchange fluctuation reserve and the hedging reserve, you normally have your exchange fluctuation reserve and hedging reserve, have been adjusted to the net profit before tax. Look at it over here. These reserves, basically which are in the nature of exchange fluctuation and hedging, if you look at it, they have not been routed through your statement of P&L account. They have not gone through your statement of P&L account. And there should therefore be no adjustment being made for arriving at the operating profits before working capital in the cash flow statement. Now, these have been adjusted by way of an error, but they have not been routed through your P&L account. If they have not been routed, if they have not been debited to your P&L account, where is the question of adding it back to your net profits? And therefore, that particular adding back, which was being done and reported by a particular enterprise, was incorrect, was erroneous. And therefore, this has been now sort of, taken as an error as such. So these are basically some of the errors that were appearing. I think we almost spoke about 9 to 10 errors that were commonly, as I repeat, commonly observed by the FRRB as of carrying out the reviews of the financial statements insofar as the cash flows were concerned. So this is all about accounting standard 3 on the cash flows. Now, I would go to the next one, which is my accounting standard 5, which is basically a lot of things. For example, net profit before extraordinary activities, my extraordinary activities, my exceptional activities, my prior period items, my changes in accounting estimates, my changes in accounting policy. So this particular standard is a very generic standard, but it gives you a very thorough perspective about what are the various components of financial statements, what components need to be specifically disclosed in a manner in which it is being required to be disclosed. How would you call something as a prior period item? What is the impact of a change in an accounting estimate? What is the impact of a change in an accounting policy? All that needs to be thoroughly sort of presented, thoroughly recognized in the financial statements, and it gives you a proper guidance. So let me spend maybe about 10 minutes on this, and then we can go to specific examples forming part of my presentation as such. Now, a business enterprise normally will have ordinary activities. So you have whatever activities you carry out as part of the business is your ordinary activities. And then there are some of the extraordinary activities or some of the exceptional activities. For example, when you sell a particular unit or a particular division, or when you sell a very large asset, these transactions are not routine in nature. They are not arising out of the day-to-day activities. And therefore, you need to be classifying those specific examples as your exceptional items. There is also a definition under the Indian GAAP on extraordinary items, which are basically items which are not being occurred during the ordinary course of business. Now, for example, if at all there is a loss from a natural calamity, that could be shown as an extraordinary item because that particular loss number or the amount of the loss could be significant to the overall financial statements. The objective of this particular accounting standard is to distinguish between what is ordinary, what is extraordinary, what is exceptional. And if at all these numbers are very material, which are being there in the financial statements, then they need to be classified separately, either in the financial statements or maybe by way of appropriate disclosures. Secondly, the financial statements under Indian GAAP, and I repeat, under Indian GAAP and not under Ind AS, also talk about prior period items. Now, under Ind AS, we are aware of the fact that there's nothing like a prior period item. It requires a restatement if the amounts are material. But where Indian GAAP is concerned, it still allows you to disclose certain things as prior period items. Now, what are these prior period items? Something that relate to the past, whether an income or an expense, which has been missed out on account of any error or on account of any omission, then it is being decided to disclose as a prior period item. Anything that relates to the prior period does not necessarily mean that it's a prior period item. Let's say that there was no error made in the earlier financial statements of the earlier period, or there was no omission being made in the financial statements, but a particular liability is accruing in the current year, which relates to the previous year, which was properly recognized based upon facts and circumstances at that point of time. But because of the fact that certain estimates are changing in the current year, or there are certain developments in the current year, as a result of which this particular liability has cropped up, it doesn't mean that you need to disclose an additional amount of liability as a prior period item. However, in the event that this particular amount is a significant amount, and although it is not a prior period item, but because of the fact that it is significant to the overall financial statements, it is material to the financial statements, it need not be disclosed as a prior period item, but you may want to disclose it separately under the notes to account saying that this is developed in the current year. It is not prior period in nature, but keeping in mind the materiality of the amount or the significance of the amount, we would like to mention this fact. They need to be separately disclosed. Now, for example, there can be a significant write-down on inventory, maybe on account of technological obsolescence, maybe on account of the fact that there is a significant shortage between the physically verified inventory and the book records. There could be also a significant disposal of an asset of a very high value, There could be a disposal of a long-term investment, which is basically of a higher value. There could be some kind of a settlement being made in the current year of a pending litigation, which is really pressurize the profits of the current year because of the fact that the settlement amount is on the higher side. So these are basically activities which have happened in the current year. These are material. These are part and parcel of your business, but they're clearly not exactly operating in nature per se. And therefore, you need to think through in terms of how you're going to be making those disclosures. Either you make it by way of an exceptional item, or you, if at all you believe that these need to be classified under the same head, but maybe an appropriate note is required to be given in the notes to accounts, then you can accordingly make those disclosures. Again, the idea and the objective of this particular standard is that as much as possible for the readers of the financial statements, it is imperative for them to be aware of the fact that what is the impact arising out of the ordinary activities and what is the impact arising out of some of these exceptional items, which need not be prior period related, but which definitely has impacted my profits for the current year. And if at all it would have not been there in the current year, then my profits would have been higher or lower in the ordinary course of business. And therefore, these are disclosed either as exceptional or otherwise as such. The next thing could be a change in the accounting estimate. Let's say you have been using a particular asset for a particular period of time. Ultimately, you realize that the life that you had determined at the beginning of the year when you had acquired this particular asset maybe was about 20 years. Now you believe that it's not 20 years, it is going to be around 12 years. And you are already in year number 6. So you cannot depreciate over the remaining 14 years. You need to depreciate over the remaining 6 years, because earlier you had planned to depreciate over 20 years. You are in year 6. You could have easily depreciated for 14 years. But now you believe that the true life of the asset is going to be another 6 years, which means a total life of 12 years or so. And therefore, you're required to change that particular accounting estimate of amortization of depreciation. And therefore, that is called a change in the estimate. Because of the fact that this particular change could be material in nature to the profits of the current period, and we know that this is going to impact the profits for the next 6 years or for the next 5 years, you need to determine the impact in terms of quantification of that impact for the current year. You also need to determine the quantification of the impact it may have for the future years, and accordingly make a disclosure, if it is material, of the impact of the current year and the impact of the future years as well. So the impact in relation to the future years will come in the notes to accounts. The impact of that will come in the current year into your notes to accounts, as well as the fact that if it is material, then it has to be shown separately in the financial statements as a separate line item, so that people exactly are aware of the fact that this is not an ordinary impact, it's an extraordinary impact on account of the change in the estimate. And therefore, it requires a separate disclosure. What else can be there as a change in the accounting estimate? For example, a change in the accounting estimate can either impact your current year, as I mentioned, or it can impact your future periods. However, for example, let's say if at all there is a potential doubtful debt which is required to be provided for, or if at all I mentioned earlier, if there is a change in the accounting estimate of a particular life of an asset. These are commonly used examples for a change in the estimate. Now, for example, when you talk about a doubtful debt, what would you do? When you know that this particular amount, which was shown as recoverable in the earlier periods, is not recoverable, you make a provision towards that particular doubtful debt. And if at all that particular provision is very, very significant to the overall financial statements, you may require some kind of a disclosure. I'm not saying always, but you may require some kind of a disclosure because that particular amount was already being treated as a sale in the earlier periods. It was always shown as a recoverable in the earlier periods. Now your estimates, evaluations say that you may fully or partly or not at all recover the entire amount. And therefore, it impacts your profitability for the current period. And therefore, you may want to make a disclosure in the notes to accounts of the impact that has on the current year profits as such. Many a times, the change in the accounting estimate does not necessarily result into quantification. And therefore, wherever it is not possible to quantify the impact of the change in the accounting estimate, then in that case, you need to make a disclosure accordingly. So how would you make that particular disclosure? Say, for example, you are aware that the impact in the current year is X. You are aware and that you have determined that you have already disclosed, fine. But the impact of that in the future years, you are not aware. Then you can make that particular disclosure under your notes to accounts that the impact of that in the future years is not really ascertainable as such. Change in the accounting policy. Now, what is basically a change in the accounting policy? Many a times, once we keep reviewing the accounting policies, accounting estimates on an annual basis or much more regularly. And sometimes we feel that the method of depreciation may not be very appropriate to really write off the actual life of the asset in a manner in which it is being written off. So let's say, as a matter of example, I'm just giving a matter of example, that you started with the straight line method of depreciation as your accounting policy. And initially, you believe that the impact of the write-off or the amortization is almost uniform over a period of time. And that's why you decided to follow the straight line method and you continue to depreciate under the straight line method. However, now you have assessed exactly as to how that particular asset is being put to use and what is the exact wear and tear of the asset, what is the exact obsolescence of the asset. And you came to a conclusion that the write-off or the impact of the write-off is significant or is higher in the current years, and it may go down or it may be lesser in the future years, which means that your presumption of straight line method in the past, which you have used as an accounting policy, is not right. And it should have been on the basis of reducing balance method or the written down value method, whereby the impact of depreciation in the earlier years is higher than that of the future years. And therefore, you need to make that particular assessment. And having particularly made that particular assessment, now you have come to a conclusion that you want to change your method of depreciation. And therefore, now you want to follow the reducing balance method. This tantamounts to a change in the accounting policy. And this change in the accounting policy means that the estimate of depreciation to date may be different from the estimation that you would have under the new method. This will impact the profits for the current period, keeping in mind whatever you have depreciated over a period of time, and this will impact also your future periods. And if the impact on the current periods is material, then you need to show that particular disclosure separately on account of the change in the accounting estimate. And of course, the future change as well, if quantifiable, you would make appropriate disclosure in your notes to accounts as such. So therefore, this is basically nothing but a little overview on what this particular standard is in terms of the current profits, profits arising out of ordinary activities, profits arising out of exceptional activities, etc. Now I will go back into the presentation, which is talking about this particular commonly observed errors in the financial statements arising out of AS5. You look at the pie chart, there is a 20% error in so far as the application of some of the definitions or the understanding of some of the definitions is concerned. Now, that is a significant percentage of the error observed where people are not in a position to understand the definitions part of it. Then again, in determining the net profit or loss for the period, there is an error rate of around 9% or so. Around 14% error rate is in relation to how the profit or loss is being determined from the ordinary activity. So over here, there may be instances where the ordinary activities also may be having some of the extraordinary items impact coming up in the financial statements as such. And of course, around 37% of the errors are coming on account of the disclosure of the prior period items. Maybe the way the prior period items are being defined, or maybe the prior period items, the way they have been disclosed. I think that's something which has come out pretty much as 37%, which is very, very concerning. And of course, there are certain miscellaneous errors under this particular standard to the tune of around 20% or so. So coming to the first example, on prior period adjustments, what basically the accounting policy on prior period adjustments are. So there is an accounting policy which is being given in the financial statement talking about prior period expenses and income are included in the respective heads of expenses and income in the profit and loss account. This is not correct. You cannot choose to have an accounting policy or a disclosure policy the way you would want to present. You need to follow the recognition and measurement principles and the disclosure and presentation requirements as given in the standards. And therefore, what is the right way of doing it? The amounts of prior period items which were not separately disclosed are required to be separately disclosed as a prior period item in the statement of profit and loss in a manner in which it is required to be disclosed. And as I mentioned earlier, once you determine your profit or loss from the ordinary activities for the current period, then you come to your prior period adjustments, disclose different items of prior period adjustments, or if you are netting off the prior period adjustments as one item, no problem. But make sure that under the notes to accounts, all the relevant significant prior period adjustments are being separately disclosed, separately identified, and separately presented in the notes so that people are able to understand what exactly is the net impact which is being shown in the financial statements as such. Look at the next particular observation or the case. Again, in one of the annual reports of a company, it says sundry balances written off being disclosed as a prior period item. Now, what are these sundry balances being written off? Many a times you have got small balances lying under debtors, lying under creditors. They relate to the earlier periods. But there is no error or omission happening in the earlier periods. These are small balances recoverable and payable, which normally a company after maybe 3 years or 4 years would want to clean it up. And they want to write back or they want to write off. They relate to the earlier periods, but they are not prior period items because there is no error or omission in the earlier financial statements. And therefore, these have to be disclosed maybe as a separate line item as sundry balances written off or sundry balances written back. And you are not required to disclose this normally as a part of your prior period item as such. I'll just step out for a second for a glass of water. Just excuse me. Coming to the next question, or the next matter. Again, in one of the annual reports of companies, some of the items of income and expenses have been shown in the statement of profit and loss under the appropriation or below the line. It's being shown as an appropriation or is being shown as below the line in terms of provisions of earlier year tax and write back of debts and sales tax dues. Now, this is not how you would be showing. These are not appropriations. I'm not even going into the observation and talking about the commentary as such. There is a manner in which you are required to disclose your earlier year's tax. So if at all there is a shortfall in the provision of tax of earlier years, or if at all there is a write back of the excess provision of earlier years, there is a manner in which those disclosures are required to be made. Although it's being made separately, but it is made as a part of your tax provisions. Similarly, your write back of debts or your sales tax dues are not below the line. What is the need of doing that? And therefore, these are incorrect if at all they are being shown as appropriations or below the line or as a prior period item. Please make sure that these are not coming as a prior period item. In one of the cases, the profit from the sale of a division of a company has been shown as a short-term capital gain under the head other income. How can that be possible? You are actually selling a particular division, which is basically forming part of your fixed assets of a company, right? This is nothing but actually an activity which is not going to be happening frequently. It is a one-time activity. It is basically nothing but an exceptional item, because whenever you sell a division or whenever you sell a plant or whenever you sell a significant asset, if at all there is a loss, whether short-term or whether long-term, these are generally long-term in nature. those need to be appropriately disclosed. And one of the best ways of disclosing it is basically an exceptional item, so that the readers of the financial statements are completely aware of the fact that these are not arising out of your ordinary activities. These are not your normal course of business. They are exceptional in nature. And therefore, such items need to come out exceptionally. And a proper note in the notes to accounts need to be given in terms of giving the background that what is this particular loss. And therefore, that reference also has to be made in the financial statements to the exceptional item where the note has been given. So this is all about, I think, some of the errors coming as part of your disclosures in terms of your net profit or loss or prior period, etc. There are not too many errors being observed as far as this particular accounting standard is concerned. And therefore, these were 3 or 4 examples which we spoke about today. Let me go back now to accounting standard 9, which is a very, very important standard. And that is called your revenue recognition. This is a very, very, very important standard. At the same time, the solace over here is that this is a very small standard under Indian GAAP compared to the revenue recognition, which we have under Ind AS, which is basically 115, which is very, very detailed and talks a lot about other things, etc., like multiple contracts, bundle contracts, etc. Over here, that kind of a guidance is not there, and it is very, very simple. Revenue is a very significant component in the financial statements because your 90% of your credit side of your P&L account is income from sales or your net income arising out of your ordinary activities, which is basically your sales activities as such. How would you recognize revenue? Revenue is recognized when there is a performance obligation. You perform your obligation, you either deliver goods or you provide a particular service where there is a transfer of ownership where the goods are concerned. So there is a transfer of ownership, there is a transfer of risk, there is a transfer of reward, there is a transfer of obligation, and where there is a certainty in respect of the amount to be recognized from that particular transaction. So 2 important parameters: transfer of ownership, transfer of risk and rewards, and there is a certainty in terms of the recognition of the amount or the consideration. When these conditions are met, at that point of time, you recognize that particular revenue, and what we call in our common parlance is recognition of sales or recognition of revenue. This particular standard is generally applicable to most of the recognition of revenue. However, certain things like revenue recognition under construction contracts is different. Government grants accounting is very different. Revenue arising out of hire purchase and lease agreements is very different. And therefore, this particular standard is not applicable for such construction contracts or government grants or hire purchase, etc. It is also not applicable to some of these realized gains, unrealized gains, because those form part of your other income, and therefore they are not being discussed under revenue recognition. The timing of the recognition of revenue in your statement of P&L account is very critical, and that timing is nothing but a combination of 2 factors, which I keep repeating, which is transfer of risk and rewards, transfer of ownership, and material certainty of the amount being realized, which is your consideration. Then you have got something like a completed service method of recognition of revenue, which means that if at all a contract is of a nature whereby it is decided that the revenue will be earned by you upon the completion of that particular service, you would recognize that revenue only when there is a service being completed. And therefore, such methods of revenue accounting are called completed service method for recognition of revenue. However, in many cases, it is not possible to wait until the entire contract is being completed. And therefore, you need to recognize revenue based upon certain milestones being achieved, based upon some of the completion milestones being achieved. And therefore, revenue recognition under such contracts is being called as proportionate completion method of recognition of revenue, whereby based upon the percentage completion method, which again can be certified by a technical expert or internally, based upon certain milestones being achieved or percentage completion, you would recognize that particular revenue as such. Then normally you will have your recognition of revenue arising out of dividend, out of interest or out of royalty, etc. Dividends are normally accounted when you have the right to receive the dividend. There have been errors, which I will talk about a little later, where people have accounted for dividend on cash basis. But when you are sure that the dividend has been declared, it has been approved by the AGM, etc., you do not have to wait till the time you actually receive the dividend in cash or it hits your bank account. When the right to receive that particular dividend is established through a resolution in the AGM, you can recognize that particular dividend. Similarly, interest. When you have your accrued, where the dividend interest can be accrued, may not be due. Interest can be accrued, but can be due. You do not have to wait till such time that the interest has to be received by you in cash. Similarly, for example, in the case of a royalty, where you are aware of the fact that obligations have been executed and you have sort of entered into an agreement with somebody whereby it is your right to receive that particular royalty, and that particular individual has completed the sales on which the royalty is accrued, or he has recognized sales on which the royalty is accrued, then it is your right to receive that particular royalty, depending upon the terms and conditions of the contract which you have with that individual or with that particular organization. And therefore, you need to recognize the royalty at that point of time. However, I keep saying this again and again, if at all there is any uncertainty in terms of recognizing the revenue, when you know that the obligation is complete, but you are not too sure as to whether this particular amount will be realized or will not be realized, then your revenue recognition needs to be deferred to a particular date where you have that certainty to recognize that particular revenue or to earn that particular revenue. Similarly, over here, what is also important is that whenever the revenue is being recognized, maybe a year down the line or 2 years down the line, circumstances change. And that particular recognition of revenue which you have done in the past leads to the belief that this is no longer recognizable, this is no longer realizable, and therefore this is going to be a potential bad debt. You need to sort of provide for doubtful debt or provide for bad debt. And if at all you are sure that you are not going to get this at all, for example, if that particular person has got insolvent or bankrupt, and you are very confident and positive that this is not going to be realized, then you need to write it off straight, because writing it off will give you a tax deduction, whereas provision for doubtful debts would then be sort of added back to your current income, on which you will create a deferred tax asset. However, you cannot straight away write off, as I mentioned earlier. You need to initiate measures of recovery. You need to demonstrate those measures through appropriate documentation, correspondence, email exchange, and then you need to write off basis what you assess that it is not recoverable as such. So this is basically a little understanding on revenue recognition. Now, if at all we need to deep dive into commonly observed errors, let me just come straight to those commonly observed errors under revenue recognition. Just to give you an understanding about how many errors, what percentage of errors were there for different parts of accounting standard, I think a good part of 6% was there in terms of understanding the definitions of revenue recognition. So people may not have understood exactly how the revenue needs to be recognized basis what the definitions have been there in the accounting standards. Around 12% or so was incorrect revenue recognition in relation to rendering of services. So either completed contract method or percentage completion method, the revenue would have not been properly recognized when it comes to recognition of revenue from services being rendered. Around 9% or so is uncertainties on revenue recognition. There can be circumstances where there were uncertainties, but those uncertainties were not being taken into consideration, and the revenue continued to be recognized by those organizations despite the fact that there were uncertainties. And therefore, there was 9% of error rate out there. But if you look at the chart, you look at it, the significant 73% of revenue recognition was incorrect only in terms of recognition of principles of revenue recognition. There are different principles in terms of transfer of risk and rewards, transfer of ownership, and many other things. And therefore, this has been one of the major considerations as far as the error rate is concerned. And therefore, we need to be very mindful of what exactly triggers recognition of revenue. So let's go to some of these examples as such. It was observed that one of the items of income, as shown in the statement of P&L account, is income from advertisement and the sale of tickets. And the related accounting policy is stating as follows. So you have revenue recognition from sale of tickets. You have revenue recognition from the sale of advertisements. And the accounting policy that was being given out there was revenue from sale of tickets is recognized when the tickets have been sold. Many of you exactly would know where the error is. Similarly, advertisement revenue is being recognized when the advertisements and net realizations are confirmed. Again, you must have understood where the error is. Coming to the response as to what it should have been or what exactly should have been done, it is very, very clear over here that you cannot recognize the revenue on tickets sold based upon the sale of tickets. You will sell the tickets in advance. But that particular event is yet to come in when the performance is yet to be given. And there can be a possibility or there can be an uncertainty of that particular event to happen. It could be natural catastrophe, it could be monsoon, it could be a pandemic, it could be anything. And therefore, you cannot recognize revenue upfront upon the sale of the ticket. There is a time gap between the sale of tickets and the actual event. And you need to wait until such time that the actual event takes place. Upon the successful completion of that particular display of the event, or the progress of the event, or the completion of that particular event, you can recognize the sale of that ticket. So this was a first step which was incorrectly being done for the sale of tickets. Similarly, in the case of an advertisement as well, that you cannot recognize the revenue as and when you sell the slots for advertisement. Something can go wrong. A paper may not be released on that particular day, or on a particular television slot, the advertisement may not come for whatever reasons. And therefore, it is not appropriate to recognize that particular revenue at that point of time when you earn the income. Because the customers can pay you in advance, and that's normally the case. But it needs to be recognized when that particular advertisement actually appeared in the media, and therefore you need to wait till such time that the slots have figured up in the media. And therefore, that is the right way of accounting. This was one of the commonly observed errors in the financial statements. The next one is an example of online educational services. Whenever there is a revenue, and these days everything is online and it's going to be virtually everything online. And therefore, over here, it was observed that your accounting policy states that the revenue from online educational services is recognized upon the receipt of the subscription fees, which are non-refundable in nature, otherwise apportioned over the subsequent subscription period. Over here, it is very, very clear. Revenue from online educational services is recognized upon the receipt of the subscription fees, which means that when you receive the subscription fees, you recognize the revenue. But you look at the tenure of this particular online educational service that you are giving. It may be a period of 6 months, it may be a period of 3 months, it can be a period of 1 year. And therefore, it is not appropriate to recognize that particular revenue upfront. And therefore, you need to recognize that particular revenue over the normal service period of the contract, which means that maybe 3 months or 6 months or whatever. And therefore, your accounting policy also is not being appropriately disclosed over here. The next one. The company has recognized as income the entire cost of garments which have been destroyed by fire under other operating income based upon the filing of the insurance claim. So there is a fire, the company has filed an insurance claim, there is a loss, and the company has actually recognized as revenue the insurance claim that the company has filed. How can you do that? Filing of insurance claim is nothing but a formality. It's a procedure. Have you received an intimation from an insurance company that this particular claim has been approved? Because once you file the claim, the surveyor is going to come and assess the loss. the surveyor will have a lot of correspondence between the company and the insurance company. There will be a lot of back and forth. And even if at all, hypothetically, if you have filed a claim for 1 crore, ultimately, after a lot of deliberations, 1 crore can be paid as an insurance claim, or 50 lakhs can be paid as an insurance claim, or zero. It can be determined that, this particular claim was fake and the fire was deliberately ignited in the premises of the company, and therefore you are not entitled to any insurance claim. And therefore, the intimation from an insurance company giving the indication very clearly that this is the amount of claim which is being approved is the basis of recognition of income. That particular amount needs to be recognized as an income. Or in case if at all there is a loss, and once this particular insurance claim is being approved, your loss can be reduced to the extent of the claim being approved to show it as a net loss. And therefore, accounting for the insurance claim upfront is not being correct. Okay. Going to the next part of this particular observation, there were also some of the goods which were partially damaged goods. And therefore, that particular inventory had been valued at net realizable value. And the insurance claim is being taken as other income. Again, that is also not correct. You need not actually account for that claim upon being filed. It needs to be determined when that particular claim, the income can be accounted for as and when that particular claim is being approved. And therefore, it was an incorrect accounting in the financial statements. Insurance claims these days get approved. Of course, it is very different depending upon the kind of loss, etc. But once the claim is being approved and intimated, it does not take more time for the claim to be received. And therefore, people should not account for the claim when the claim is being filed. They need to account for the claim when the claim is being approved by the insurance authorities. And there is no ambiguity or there is no uncertainty for the claim not to be received. And that's why you will account for your insurance claim as such. You look at the accounting policy being given in one of the companies where it says that dividend is accounted as and when received. And income and expenditure are recognized on accrual basis, except dividend on shares and units of mutual funds, which are recognized on cash basis. You cannot have these kind of accounting policies. How can you pick up these accounting policies and just put it the way you would want to? These are not appropriate. These are not fair. So generally for dividends, as I mentioned earlier, it is accounted when the right to receive the dividend is established, which means that a resolution being passed at the AGM of the meeting where you are holding the shares of that particular company. Once that particular AGM resolution is being approved, you have a right to receive that particular dividend. It may come to you at a later date, but you can account for that particular dividend income at that point of time. Another accounting policy on revenue recognition, which is being disclosed, is revenue or income is recognized when no significant uncertainty as to measurability or collectability exists, which is fine. Revenue is accounted on accrual basis. Sales are accounted on dispatch of products. This is again not correct. Okay. In the first case, revenue has been recognized when there is no uncertainty as to its measurability and collectability. Whereas if you look at the second case, it simply states revenue is accounted on accrual basis, which means that you have sold something, you believe that you have earned to receive that particular income, and therefore it needs to be accrued. The limited point I'm making over here is that please make sure that your accounting policy is exhaustive, is extended enough to say very clearly that there is a transfer of risk and rewards, and that there is no material uncertainty about that particular income not to be received. If at all you miss out on those particular specific aspects to be a part of the disclosure of your accounting policy, then your accounting policy is incomplete. And mind you, incomplete accounting policies or erroneous accounting policies are equally important and are measured with the same strictness, although it's a disclosure item, are measured with the same kind of a strictness as far as the reviews are concerned. And therefore, your financial statements could be said in having errors if at all these disclosures are not appropriate or are not adequate as such. Again, another revenue recognition policy over here is on sale of investment. It says that profit on sale of an investment is recognized as income in the period in which the investment is sold or disposed of. Profit from sale of an investment definitely is not an ordinary activity. It's not arising out of the sale of goods or services. And therefore, your revenue recognition policy cannot have any disclosure of an accounting policy for purchase of an investment or sale of an investment. It has to come separately because those are being disclosed separately as other income. Your revenue recognition is only the recognition of revenue of your core activities. It could be sale of goods and services, or it could be anything that the company is dealing in. But in case if at all you are selling an investment, and if at all there is a gain, that is your other income. And therefore the heading, if you look at under the case, the heading is revenue recognition. This accounting policy should not be forming part of your revenue recognition. It is an accounting policy forming part of your other income, and therefore it needs to be disclosed accordingly. So these were some of the important items which are basically errors in nature as far as your accounting standard 9 on revenue recognition is concerned. I will now quickly go into a couple of examples for paucity of time. I'm avoiding in terms of a description of accounting standard 7. I just wanted to sort of, share with you some of these commonly observed errors, which are only a couple of errors under AS7, because AS7 is not a very easy standard as well. It applies only to construction contracts. I keep repeating this again and again in every seminar that this particular construction contracts is not applicable to a developer who is developing a particular property or a particular estate. It is applicable to those individuals who are involved in the provision of construction services. And therefore, construction contracts are applicable only to those organizations who are in the business of construction. And therefore, the recognition of revenue will be based upon certain milestones being achieved during the course of construction, which is again significantly percentage completion method, whereby a particular contract of construction being completed in a phased manner, depending upon the percentages of completion, would lead to revenue recognition, and accordingly would lead to the recognition of costs which are related to these construction contracts. Again, if you look at it, I think there are not too many different kinds of errors, but the significant errors are basically in relation to some of these recognitions and some of the misinterpretations of these accounting standards per se. Okay. One of these errors is basically in relation to construction contracts accounting policy, whereby the accounting policy is saying that the job work revenue, now this particular company is into job work, and therefore they are saying that job work revenue is accounted on the basis of running bills raised and approved by the clients. Revenue expenditure, which is against this particular job work contracts, is accounted on accrual basis as and when it is being incurred. Paragraph 21 of this particular standard says very clearly that you need to recognize revenue and costs based upon the stages of completion of the contract as on the reporting date. And therefore, you cannot account for this income and expenses based upon what has been approved by the clients. Your clients may partially approve, your clients may fully approve, but your income and recognition or your income and cost recognition needs to be basis percentage completion method. And therefore, you need to determine exactly what is the percentage completion and accordingly account for your revenue and accordingly you account for your costs as well. The next question or the next matter is again in relation to an annual report where it says that the company which is involved in the construction business and its schedule of inventory also include an item of job in progress. However, no other disclosure was made in the financial statements. So again, over here, whenever you have these kind of disclosures, they are not adequate disclosures or they are not complete disclosures. Whoever is involved in the construction business, the following disclosures are a minimal as far as your disclosures are concerned. First of all, the aggregate amount of the costs which you have incurred and the recognized profits up to the reporting date. So you will recognize your revenue. You against that revenue based upon the percentage completion method, you also account for your aggregated costs. And therefore, your profits arising out of those activities which you have completed and you have completed basis percentage completion, you have your recognized profits. And therefore, that disclosure is also very, very important. Because you're in this particular business of construction contracts, you keep receiving a lot of money in advance because you need it for your working capital requirements, you need it for your other requirements for carrying out the business, etc. And therefore, your disclosures are also related to your amount of advances that you receive. You need to make those particular disclosures as well. And the amount of retention money that you may have paid or you may have received, depending upon if at all it's a subcontracting that you may have received. If at all you have contracted, if at all there is a contract which you have signed off with a customer, then you must have paid your retention amounts, etc. And therefore, you need to make those adequate disclosures, which are part and parcel of the requirements of AS7, which have not been there in some of the financial statements that the FRRB and other reviewers have actually observed. So these are only a couple of examples which are commonly observed errors under AS7. And this is all where I am concerned in terms of taking you through some of the important elements of the accounting standards and some of the commonly observed errors. And we have about 20 minutes available now for some of the questions that would have been sort of presented on the portal. And let me just get into that. I think, yes, I can see those questions. And maybe I can answer those questions as well. And I'm presenting that particular question here. 1 second, please. Devang, is the presentation still appearing on the webcast?
Yes, sir.
Okay, fine. I will just read out the questions for the benefit of some people. There are quite a few questions, so let me see. Oh, there are many questions. I will try and see whichever are there. If at all these can be answered, and if at all they cannot be for the paucity of time, maybe I would request the participants I will share my number, and the participants can call me over the weekend, and I will be able to answer those questions for sure. Sorry, Devang, I lost the questions, so let me go back and see where the questions are. Okay. There are quite a few questions, so I will not be able to answer all, but I will answer as much as possible for the benefit of everybody over here. Somebody is asking me to talk about going concern in this COVID environment. So friends, as I mentioned at the outset, that this particular seminar or webinar of the Institute is only in relation to these accounting standards, and I would not want to deviate from these accounting standards. Happy to share with anybody anything on going concern, etc. under the COVID environment. The Institute has done quite a few seminars of auditing under the COVID environment. I have presented in a couple of them as well. So maybe I would request that particular individual to get in touch with me over the weekend, and I will be able to answer that question on the COVID impact. Okay. The next question is on how changes in the closing stock valuation on 31st March 20 and valuation of the same as on the balance sheet date. I think the question is not very clear. Changes in the closing stock valuation. There cannot be a change in the closing stock valuation even under the COVID environment. If at all you are not in a position to go and physically verify the inventory, you need to carry out alternate procedures, and your valuation will not change under the COVID environment. However, in the event that the organization believes and it can be proven that the net realizable value of the inventory has gone down substantially on account of this particular pandemic, given the fact that it may not have a ready market to sell, then you need to bring down that particular inventory to its net realizable value, and accordingly you need to carry out your valuation. Next question is coming on the NBFC loss of interest on standard assets in NBFC. I think I would suggest again, NBFC's accounting can be of two types. There are NBFCs which are still under the earlier regime where expected credit loss model is not applicable, and therefore the IRAC norms are applicable, and therefore you need to follow those IRAC norms, and you need to follow specific provisions of moratorium, etc., where there are certain percentages being given for provision for COVID-related advances, etc. Where it is in relation to NBFCs which have adopted Ind AS expected credit loss model should take into consideration all the stress, including the stress of the sectors, and where you don't take into consideration the direct norms. So I just wanted to highlight that particular point. I'm not obliged to say that, but just for the benefit of that individual over here. Then the next question is on reconciliation between cash and cash equivalents as per Schedule 3 and as per cash flow. Ind AS is required to be disclosed due to the difference for other bank balances. Yes, because of the fact that you will have your other bank balances which are basically not available for use. You cannot put to use. You cannot have you have certain unclaimed dividend accounts which cannot be used, etc. And therefore you need to have a reconciliation between the cash and bank balances appearing in the financial statements and cash and bank balances forming part of the cash flow. And that particular reconciliation you need to carry out as a part of a note under the notes to the cash flow as such. How to report the impact of COVID-19 on revenue recognition as per AS9? Will AS9 revenue recognition will change the reporting after COVID-19 and in future its impact arises? See, friends, I would just like to make a very important announcement that COVID-19 does not change your accounting standards. COVID-19 is a pandemic and the impact of that needs to be assessed. So for the benefit of everybody over here, my suggestion would be that whatever is the impact of COVID-19, you need to do an assessment of that particular impact on substantial and significant components of the financial statements. Sit down with the company management, sit down with the CFO and the finance team and understand that particular impact. And having understood that particular impact, you need to determine what kind of disclosures and what kind of recognition and measurement principles you need to follow to give effect to that particular COVID-19 impact. Because of the COVID-19 impact, there is no question of any dilution of an accounting policy, nor there is any question of dilution of the content of the accounting standard. So that is something which should be very, very clear. Okay. Is there any disclosure needed due to change in the accounting policy which results in the cash flows? Whenever there is a change in the accounting policy, first of all, you need to understand as to what drives a change in the accounting policy. There has to be a rationale for the change in the accounting policy. The income tax department, the bankers, the users of the financial statements would like to be aware as to what causes the change or what triggers a change in the accounting policy. And therefore, that particular change has to be understood. The rationale for the change in the accounting policy has to be disclosed in the notes to accounts. The impact of the change in the accounting policy on your current numbers and on the future numbers needs to be quantified and needs to be disclosed. And if the impact is material, it needs to be disclosed separately. If the impact is not ascertainable for the future years, then again, it needs to be disclosed accordingly in the notes to accounts, etc. Somebody is asking, please send me all the Ind AS PowerPoint so that we can have a reference in the future. I think there are enough presentations there in the public domain as far as Ind AS is concerned, including some of the institute-related Ind AS. My suggestion would be to get into that particular website and avail those presentations as such. This particular presentation will be there with the institute and will be there on the website, and you will be able to access this particular presentation also. But this, I said, is not on Ind AS, it is on Indian GAAP per se. Then the next question is about what are the circumstances when the cash flow cash balance and the cash and cash equivalent balance in the notes do not match. I think I've given a perspective about that, that some of these items which are basically non-operating in nature, or where you have an unclaimed dividend, or where you have these particular lien or restrictions for the use of cash, you will have those kind of differences which need to be shown under the reconciliation, etc. How we will give the impact as per AS5 for the period if any events happen after the pandemic situation. So the question is, how will we give the impact of AS5 if any that happens after the pandemic situation? Now, friends, this is a good question. It is more of an audit requirement rather than an accounting standard requirement. What is currently as of 30, and again, I'm sharing from my experience. If you look at it, when you are finalizing your 31st March 2020 balance sheet as an auditor, or even as an organization, as a company, if at all you are working in a finance company, working in a company and you're finalizing this particular financial statements, you look at exactly the assessment of the impact of this particular pandemic on your financial statements, on your company. I can tell you for sure that in many, many organizations, the impact is not material, because this particular impact of the pandemic started from the 21st or 22nd of March. And until then, the business was as usual. The real impact will be coming up in the current year, which is the year 21-22. It will come up in the first quarter, it will come up in the second quarter. Now, because of the fact that it depends upon the nature of the business, it depends upon the nature of the industry, it depends upon the sector. The impacted sectors could be hospitality, travel, tourism, aviation. The questions on going concerns, etc., will arise in those sectors. And therefore, there is a lot of future uncertainty in those sectors. But there are certain sectors, for example, consumer goods, for example, dairy, for example, fast-moving consumer goods, etc., which may not be significantly impacted. So wherever you believe that there is a future uncertainty, the best way to consider would be to make an appropriate disclosure in the notes to accounts of the future uncertainty. And if at all you believe that the future uncertainty is significant and you are not in a position to determine, you may consider giving a para of emphasis about that particular future uncertainty. In the event that the future uncertainty is not there or is marginally there as of 31st of March, and you are in a position to demonstrate in your work papers of having understood what the management has said, if you are able to review the business performance of that particular company for the months of April, May, and June, and if you see that the company is not significantly impacted by COVID, and if at all your net worth is not getting eroded, or if at all you believe that the impact is not significant, then also you need to consider that whether a para of emphasis on future uncertainty is required or is not required. I have always been saying this in many webinars that just do not go uniformly and think about having a para of emphasis in every particular company that you are finalizing. You will have to assess on a case-to-case basis and accordingly make an appropriate disclosure in your audit report on the para of emphasis and not otherwise as such. Somebody is talking about accounting policies. Companies are writing off preliminary expenses in 1 year instead of according to the Income Tax Act. It may be a cash flow within the same. These things are not there anymore in the financial statements. Your preliminary expenses, etc., are not there anymore. You cannot amortize. See, whatever the treatment is there under the Income Tax Act over a period of 4 years or 5 years is different from what the Companies Act says is what the accounting standards say. And therefore, do not drive your accounting basis the income tax. You have a different method of depreciation on the income tax. You have a different method of depreciation on the Companies Act. You can write off preliminary expenses under income tax, but you are not required to adopt the same treatment as far as your Companies Act is concerned. And therefore, do not get guided by the income tax practices, etc. So again, this is something which I had highlighted earlier also, and you need to say. Loss from COVID. How could we deal as not auditory? Yes. In case if at all you are in a position, let me be very honest with you, it is a matter of time that we will learn more things about the exact quantification and impact of the loss caused on account of COVID. As of 31st of March, organizations are not in the best circumstances to determine what is exactly quantifying the loss of COVID. It can be anything. But maybe as of 30th June, as of 30th September, this could be different. How are you going to be disclosing it? What is a way of quantifying it? What is a way to present it? Is a matter of time. There is no specific guidance per se. Can you call it as a loss arising out of COVID and show it separately? Not to the best of my knowledge at this point of time. But we will see how this evolves, because ultimately the loss is on account of the pandemic and is caused on account of the economic recession. And therefore, it may be difficult exactly to identify to what extent you could have made the loss. Because even if at all you would go on the basis of your budgeted sales, and if at all you would have presumed that my profit for the first quarter hypothetically could have been 10 crores, but now my actual loss is equal to 40 crores, which means that your loss on account of COVID is around 50 crores or so, is what you will think. But that may not be the right way of disclosure. That may not be the right way of interpretation. So let's await till such time that there is more guidance on this particular front per se. Okay. There is again a question for the institute. Please update about the link for downloading or purchasing of the book issued by the FRRB on commonly observed errors. I deliberately read this question because I think many of you may be interested to have that particular book, or maybe the institute would do something in terms of having that particular link on the website as such. Whether change in the depreciation method is a change in the accounting policy or a change in the accounting estimate. Of course, it's being decided differently, but I personally believe that a method changing from straight line method to reducing balance and reducing balance to straight line is basically a change in the accounting policy. If at all you continue with the same method of accounting policy, which is could be reducing balance, and you change your estimate or change your useful life of the asset, then that becomes a change in the estimate and not a change in the accounting policy as such. Something is mentioned about the sale of a division. What is the correct way to disclose? So when you sell a particular plant, or when you sell a particular unit, or when you sell a particular division, you are in a position to determine the impact of the loss arising on account of that particular sale. And that basically is not a loss from an operating activity, is not a normal loss, and therefore you need to disclose it as an exceptional item in your financial statements below your profit from ordinary activities. If you open up balance sheets of large companies which have got diversified interests, which have got multiple plants, you will see this very regularly, that they will sell off a particular arm of business, or they will divest a particular unit, and there can be a loss or there can be a profit. These are exceptional in nature because even the numbers of profit or loss are significant. However, as I keep mentioning this and again, and this was an error observed in the financial statements also, somebody felt that this particular loss is a prior period item because I had this particular plant running in the earlier years, and that particular plant is being sold now. And therefore, the profit or loss arising on account of the sale of plant is some of earlier periods, and therefore I should be classifying it as a prior period item. It is not a prior period item. It is an exceptional item per se. Okay. The question is, if the amount of prior period item is not material, are you still the aggregate amount required to be shown in the main profit and loss account? No. If the amount is not material, and if it is below your materiality thresholds as an auditor, you need not make any specific disclosure per se. Again, a lot of questions coming on loss of revenue on account of COVID, etc. I think let's wait for some more guidances to be out on this. We have a good amount of guidance from the institute. I would request you to have a look at it, but I haven't seen any, at least I haven't come across anywhere where a particular assessment is being made on account of loss of COVID and that is being disclosed separately as such. Yeah, there is another question in terms of happening of an event being uncertain. So if at all you believe that you are into providing services and you have delivered the services, your services are complete, but there is still an amount of uncertainty in the recognition of revenue. Would you recognize that particular revenue? Answer is no. You will not be in a position to recognize the revenue. As I said, there are two important factors for the recognition of revenue. One is that there should be a transfer of ownership, which means transfer of risk and rewards between the buyer and the seller. There should be a delivery being sort of delivery is the underlying in terms of the goods being delivered at the premises of the buyer generally. And finally, of course, there should not be any uncertainty in terms of collection of revenue. If these conditions are met, then that's the trigger for the recognition of revenue as such. If insurance claims are not to be recognized until they are approved, does it not affect the true and fair view concept, especially when the claims form a significant part of the financial statements or the total revenue? That's a good question. I mentioned this earlier also, that insurance claims are basically made to the insurance companies when the loss is being assessed by the company. Then there is a particular assessor who comes and assesses. According to him, the claim can be of a lower amount. According to him, the claim may not be genuine. And therefore, that particular process will take a lot of time. You have filed a claim. It doesn't mean that you need to recognize that particular claim right away in the financial statements, either as an income or as a reduction from the particular loss that has been caused and that has been debited to the P&L account. Your claim will be recognized when it is approved, when you are formally communicated by the insurance company through a writing, where this particular claim is being awarded to you. And that is where you will recognize, because now there is no uncertainty in recognition of revenue. And as I mentioned earlier, and I keep repeating again and again, revenue cannot be recognized where there is uncertainty to realize the revenue. And therefore, you will recognize the claim as and when the claim has been approved. There's one more question, and I think that will be the last question. That is on non-recovery from the debtors due to COVID impact. Will it have same impact as bad debts written off, or will it be treated and disclosed separately? It's a good question. See, when you have actually sold your goods or sold your services, you have actually done this in good faith. At that point of time, you have your credit assessment being done of that particular individual, that he or she or the company would be repaying that particular obligation in terms of the revenue that you are entitled to earn. There was no uncertainty when you made that particular transaction of the revenue to be recognized. And therefore, you made that particular transaction. In the course, if that person is impacted on account of COVID and he is not in a position to pay, according to me, you cannot recognize that particular loss in your books as a loss on account of COVID. It is your normal loss arising in the ordinary course of activities. And therefore, you need to make a provision on lines very similar to what you would normally make it during the course of your audit or during the course of your financial reporting. But as I keep mentioning, these are testing times. There will be a lot of guidances coming out from the institute and maybe from other bodies as such in terms of how certain things need to be properly accounted, what kind of disclosures are required, both from an accounting standpoint and from an auditing standpoint. And I think it's a wait and watch. My only suggestion, I think I'll just spend a half a minute on this. My only suggestion is that many of us are actually doing the audits, or rather all of us are doing the audits under a virtual scenario, whereby we are not visiting the client premises. We are not visiting other premises or branches, etc., as part of our audit requirements. But we are required to observe the same standards of auditing. We are required to follow the same standards of accounting to ensure that the recognition and measurement principles are held in very high esteem. And even your presentation and disclosure requirements should be given the same treatment. So friends, I keep repeating this again and again, that because of this particular pandemic situation, do not compromise on application of accounting standards, do not compromise on the auditing standards, do not compromise on the quality of the audit. The audit has to be done with the same rigor, because that is the expectation of the institute and the regulators. And therefore, you should not leave any stone unturned, thinking that somebody is going to be reviewing you with a lesser rigor under the current environment, and you may not be questioned given the kind of practical difficulties that you are facing. You have to understand that if at all the normal procedures are not possible, then you need to think through those alternate procedures to be carried out for your audit. And as I keep repeating again and again, it needs to be done with the same rigor. So with this, I conclude this particular presentation. I thank you all for being there on the webinar, patiently hearing me for the last couple of hours. Apologies if I have not been able to answer your questions, or if I have not been able to meet your expectations. My cell number is 98203 48325, and I would request you to call me only during the weekends, only on the coming weekend, if at all you have any question which I have not been able to answer, I would be able to do so over the coming weekend. And I also thank the Institute once again and the ASB and the FRRB for giving me this wonderful opportunity to make this particular presentation on commonly observed errors in the financial statements in relation to the accounting standards 3, 5, 7, and 9. With this, I conclude my presentation. Thank you all. Take care, stay safe, and God bless.